Let's get to our guest host, Ashok Shah, the CIO of London Capital. Joins us for the next 2 hours. Ashok, just to summarise where you stand, I mean, some people are into huge moves to the upside in this market, huge moves to the downside. That you're much more cautious than these exuberant views either side.
I think so. You know, after the huge rallies of last year, I think it's time for the markets to consolidate. But of course, underlying on the background really is a picture in Europe which is deteriorating very rapidly. There's a risk of double-dip recession, you know, around the corner. We've already seen in the fourth quarter Italy continuing to shrink and so on. So given the sovereign debt crisis that is going around the Mediterranean countries, you know, this is going to put a lot of pressure on Europe. And what we have seen is that the credit default swaps on the sovereigns have been rising quite rapidly. This is telling you that the cost of capital is rising. And when cost of capital is rising, in essence, equity markets really can't make any progress.
Ashok, companies are repairing themselves, but I guess governments can't afford to just yet. Well, that's the big debate, isn't it? Can they afford to start cutting these deficits, or do they still need massive stimulus for the economies? I'm guessing the latter.
Well, I think it's a little bit too early to start, cutting the deficit right now. We just got the economies coming out of a pretty big recession. You know, they are cruising, but at a very low pace. We need to see some sustainability in the growth rate for the next few months before they can begin to unwind.
Do you think markets will be patient enough? I mean, we've seen sovereign issues have been raised by the markets and the widening yields, and it's an enormous amount of money that still needs to be raised. You say it's too early for them to take deficits off the table, or certainly start cutting those deficits. I will take that, but what I'm wondering is, will the markets be prepared to wait?
Well, what the markets are really looking for is a reduction in uncertainty, so they're looking for some kind of medium long-term plan on how the deficits are going to be tackled, whether the taxes are going to be raised by how much and in which kind of taxes, and also in terms of where the expenditure is going to be cut, how they're going to organize those cuts. So once we have some kind of long-term plans on the table, I think the markets will begin to calm down and become a little bit more relaxed in the way that the numbers are evolving for the next couple of quarters.
Yeah, I mean, I was looking at your notes, and I've lost this specific page, but I'm pretty sure you've written in your notes that the governments haven't really got much firepower left. They can't boost their leverage anymore. So if we do see, and we're seeing it in the concerns of many of these companies, a double dip, a dip back down into recession, then there isn't the firepower from governments to come to the rescue this time.
Absolutely. I mean, the governments have done everything they can possibly do. The central bankers have pretty much taken the interest rates to almost the zero level. We've had huge amount of quantitative easing, which is injection of liquidity, and we've seen massive counter-cyclical policies which have resulted in huge budget deficits. So in essence, everything that the authorities can do is on the table right now. The key question is, you know, can they keep it going rather than increasing it, because the room to increase is very limited. And of course, at the same time, they have to gain the market's confidence that they have a plan on how to go back to a normalization of both the budget deficits and also longer term the interest rate cycle as well.
You got any good news for us?
Well, that is pretty good, because if we can get this kind of information out of the authorities, then the uncertainty levels will reduce and the volatility in the marketplace will reduce, and all of a sudden the assets may begin to look fairly good value.
Yeah, and talk about value, because is it the case, as appears on the surface, that whilst the governments can't deleverage at the moment, companies have done a very good job of doing so? They've cut their debt extraordinarily. That appears to be the anecdotal evidence, speaking to a lot of CEOs every single day. So in terms of their valuation, actually they're looking rather good compared with the broader macro picture.
Indeed. I mean, the companies over the last year or so have been deleveraging very gently, and the reason for that is that the end demand has not really picked up, so there is no need to engage in a big capital spending cycle. So the cash flows are really going in to reduce their debt levels. And this is really great news for the balance sheet in terms of debt holders, because the security of the debt holder, the credit upcycle is all in track.
So corporate credit is an area very focused